Hi everyone, welcome to Karan Scan. Today I'm going to kick off with HDFC Bank's earning results. As you know, HDFC Bank's results came out today on a Saturday, and there was a surprise profit growth that a lot of analysts were not expecting. But there were some key issues that I identified in their financials that I would discuss in this presentation. Nothing too worrying, but it's all on your discretion. If you think it's worrying, it might be worrying. If not, it might not be worrying. But again, everything looks good. So let me have some background on it. So India's largest lender, largest private sector lender, kicked off the earnings season for the nation's finance sector with profit that surpassed analyst expectations. Analysts were expecting about 15,650 crores in net income. However, HDFC Bank surprised all the analysts with a net income of 16,170 crores. This is important to understand because, well, the big analysts from these big fat financial institutions, if they have a estimate, the price of a share basically factors in that estimate. So when an estimate is beaten, be it for the better or for the worse, it reflects poorly or greatly on the share price. But if an estimation is met, the share price does not change that much because, well, it was already expected and there's no surprises in room. Again, if I look at the net interest income, it rose to 73,000 crores, again, beating estimates. If I look at gross non-performing assets, so the gross non-performing assets widened to 1.33% from 1.24% when I compare it to the previous quarter. Provisioning fell by 81% to 2,600 crores when I compare it to the previous quarter. Now, something important needs to be discussed here. The CEO, Shashidhar Jagdishan, aims to lower its credit deposit ratio. So he aims to lower the credit deposit ratio for HDFC Bank because it has elevated a lot after the recent merger with its parent. As you know, HDFC Bank merged with HDFC about the same time last year. Hence, the credit deposit ratio has increased. So, what exactly is a credit deposit ratio? So, credit deposit ratio is a measure of how much of a bank's deposits are being lent out as loans. Um, so, recently, RBI feels that the country's credit deposit ratio is at all-time high. Thus, HDFC Bank might be asked by RBI to sell some of its loan portfolio, and it seems that HDFC is looking to sell its loan portfolio, some of its loan portfolio to companies out there, and it has been in talks with some other companies of a possible sale. So, with loans growing significantly faster than deposits in India and the economy expanding towards 8%, decision makers at not just HDFC but other banks are under pressure to address this potential financial risk that might be building. Basically, if I have bank deposits of say 1 lakh rupees and I have loaned out 1 lakh 10,000 rupees, this means I have a credit deposit ratio of 110%. And it can be a double whammy because hey, if the loans go bad or if I have a run on my bank, I can things can go bad really fast, really soon. So um if I talk about HDFC Bank's credit ratio, it was about 110%, just like the example I just described to you, after the merger with HDFC. Since then, it has dropped to levels of 104%, but it still remains much, much higher than what the bank had between 2021 and 2023. Bank had a credit deposit ratio of 85 to 88%. So a lot of work that needs to be done there. Something that you should keep your eyes out, ears open for, because this can be a game changer for HDFC Bank. Now let us just move forward with what we started this video for. It is basically discussing the earnings of HDFC Bank. So net revenue, we have seen a drop in net revenue. Operating expenses, again a drop in net revenue. Now I'm looking at quarter on quarter basis. Please do not compare quarter one financial year 2025 with quarter one financial year 2024, because right there in the bottom you can see HDFC Limited merged with HDFC Bank effective July the 1st, 2023. Hence, the numbers that you're seeing is just of HDFC Bank in quarter one financial year 2024. Thus, you see such a high jump and you be like, oh, there's a year-on-year increase of 106%. But no, you're comparing apples and oranges, but and not apples and apples. Like I said, provisioning has reduced from 138 to 31.4, and consolidated profit has sort of reduced. Profit before tax, a 28% jump in profit before tax, and this is what surprised a lot of analysts. Now, if I look at income statement, nothing particular to call out here. It's sort of flat. Non-interest income has sort of fallen down, apart from net interest income. And for a bank, you should not look at non-interest income with a microscope, because, well, it is not the business of the bank to generate not interest no, non-interest income. Bank's primary business is to generate interest income, and it is the interest income that can make the bank or break the bank. All right. Now, this is a very important slide. As I discussed before, RBI is looking to crack down on banks with the really high credit to deposit ratio. On the left-hand side, we see average deposits. So average deposits stand at about 23,000 billion rupees. Whereas average advances under management, that means average loans given to the market, is at 25,327 billion, well above the deposits HDFC Bank has. However, HDFC Bank seems to aggressively expanding on its deposits. We see a 5% growth in its deposits compared to the previous quarter. This is a good jump for a bank in one quarter, whereas it has tried to control the average advances it has given. There has been a jump of only 80 basis points or 0.8%. HDFC Bank is doing fine there, but still there's a lot of room for HDFC Bank to make changes. It would have to sell some of its loan book, or it would have to rapidly expand its deposits, which is highly unlikely. So expect a small portion of loan book of HDFC Bank to be sold in the market. I'll be very curious to see what loan book it sells and what's the price it gets given the current market scenario. All right. If I look at retail deposits, so we see over the year since September 2023 to June 2024, we see the composition of the retail wholesale deposit change, not by much, but still change. Basically, retail deposits are deposits made by yourself and myself, whereas wholesale deposits it's a way money is uh, it's basically how large corporations and financial institutions obtain their working capital for short-term financing. So wholesale funding can be quick to arrange, but can be extremely dangerous to rely on. Banks discovered this during the financial crisis in 2008, 2007, and excessive use of short-term wholesale funding instead of retail deposits can leave banks exposed to liquidity risk. And this is particularly important in an environment where there are huge interest rate fluctuations. So RBI Last month, RBI also said that banks must reduce its reliance on wholesale deposits to fund loans and be watchful of the risk associated with their advances and trading exposures amid interest rate fluctuations. Just the point I had shared before. So RBI is sort of clamping down on two things: reduce your wholesale funding and improve your credit deposit ratio. Something HDFC Bank has to work on for both these pointers. Um, Next, proportion of CASA deposit. So what is CASA? So CASA, the CA of CASA is current accounts, the SA is saving accounts. So basically, CASA ratio stands at the basically the ratio of deposits held in current accounts to the deposits held in savings account. So CASA ratio is important for banks because it gives an idea about the the cost of borrowing. So what is the cost of borrowing for a bank? It's highly determined by the CASA deposit it has. So what basically happens in a current account is basically banks pay negligible interest rates on you holding cash in your current account, whereas they pay higher interest rates for the cash you hold in your savings account. Thus, intuitively, it kind of makes sense of keeping a high CASA ratio, because if I have a lot of money stored in current accounts and lesser money stored in savings accounts, effectively my cost of borrowing has reduced. So if you look at here, the CASA ratio has reduced from 38% to 36%. That means the cost of borrowing for HDFC Bank is going up. If I keep it in tandem with what RBI is expecting HDFC Bank to do, RBI also wants HDFC Bank to reduce its wholesale funding. Hence, HDFC Bank is in quite of a pickle. But again, no alarm bells here if this situation persists, which I don't think it would. But if it persists, it is bad for any bank, not just HDFC. But HDFC is, well, the biggest private lender and it's rock solid, so no worries there. So let's go on. Let's look at the loan book. So basically, when a bank lends out money, it lends out to the retail segment and it lends out to a wholesale segment. If I look at retail loans have increased. Majority of retail loans are mortgages, which is basically 61%, then followed by personal loans, followed by auto loans and two vehicular loans, and lastly 8% at payments. Payments include things like credit card, easy MI, etc., etc. Moving on to the next slide. So what is the corporate rating mix of the money lent out by HDFC Bank? We see that overall, the bucket of BB and below, that means shit companies, is has sort of increased from 11.7% to 11.8%. Also, if I look at triple B rated companies, it has increased from 7.1% to 7.4%. And it comes at the expense of better quality loans. That means loans that are AA and above and A. So, nothing to worry here. Also, it's just a few basis point shift, but again, this should not persist as it can be bad for any other bank. Now, looking at risk-weighted assets. So, what exactly is a risk-weighted asset? So, risk-weighted assets are used to determine the minimum amount of capital a bank must hold in relation to the risk profile of its lending. That means if I have very risky loans, I have high risk-weighted assets, and I have to hold much more money in case those loans go bad, loans go sour. If I look at risk weight density, now this is sort of important because risk weight density is basically so if there's an increase in the risk weight density, as we've been seeing from September 23 to June 2024, it's not a good sign. It shows that the risk profile of the bank's assets have deteriorated. And this kind of makes sense with the slide I showed you before, where the corporate rating mix has changed to worse loans. Not that bad, but a little worse than what it was before. And that's being reflected in the risk weight density. And if I give you some more information about risk weight density, an increase in risk weight density over a period, a decrease in risk weight density of a bank would also indicate the risk quality of assets have improved. Again, and we see something that's opposite to it, and hence the risk quality of the assets have not improved. Sometimes this may arise due to higher risk weight substituting lower risk assets. Now, I don't want to go deeper into this, but basically the summary for this slide is that HDFC Bank is writing riskier loans, and it is making necessary changes to make sure that it is able to cover these risky loans. And we look at it on the later slides. Yes. Again, gross NPA and net NPA. So what exactly is gross NPA? What exactly is net NPA? So gross NPA is basically the total value of non-performing loan asset of non-performing assets before provisioning. So 1.3% of loans by value are non-performing. They end up being poorly. Whereas if I look at net non-performing assets is basically gross NPA minus the provisions the bank has held for that NPA and any write-offs. So we see that the net NPA is much lower at 0.3%. Again, these numbers are very, very good for compared to other banks that are out there, but it is increasing. We are seeing a slow uptake in both gross NPA and net NPA. Again, in conjunction with risk-weighted assets being increase in risk-weight density. If I look at gross NPA by segment, we see the retail loans are the best. Gross NPA for retail loans are at 0.8%. So, and if I look at CRB, so CRB is the bank's commercial and rural banking group, where it caters to the needs of micro, small, and medium enterprises, emerging corporates, commercial agriculture, small and marginal finance, healthcare finance in rural areas, equipment finance in rural areas, and transport finance in rural areas. So it's been segregated into two aspects. We have just CRB, commercial and rural banking, and we have commercial and rural banking excluding agriculture. Now, why is this segregation made? Well, you can look at the numbers itself, and you can see, well, agricultural loans are pretty much worse than the overall bucket of CRB. And over the quarter, we have seen an increase in almost all buckets. And given the budget that's going to come out in Tuesday, I feel farmers are going to demand loan waivers, and the loan situation in the agriculture market might not be as good as it seems. But again, these numbers show deterioration of gross non-performing assets for all segments. Though retail and CRB excluding agriculture is sort of flat, there's a few basis point change. Now, going to the next slide, movement of non-performing assets. So this is basically called a waterfall graph. Let me just show you how to read this graph. How this graph is read as, for example, if I look at the bottom graph says gross NPA as of December 23. So this is again in billion rupees. So there was a gross non-performing asset of 310 billion rupees. There were slippages. There were slippages of 73 billion rupees. So what exactly is a slippage? Slippage is a loan that has gone bad. Any loan that has gone bad is identified as a payer who has not paid any interest or any payment on the loan for more than 90 days. That means 73 billion 73 billion rupees worth of loans by payers were not paid in the past 90 days. So we basically add the slippages to the gross non-performing assets. What happens is these loans would go to recoveries. So this is currently in collection. This goes in recoveries. They are recovered by recovery agents. A good portion of this money is somewhat recovered. It depends on the asset recovery model deployed by the bank that calculates how much recoveries are possible for a particular asset. So we see 45 billion rupees have been recovered. Again, these 45 billion rupees are not from this bucket of loans, but it is from the bucket of loans that have gone bad in the previous quarters. So 45 billion rupees has been recovered from it. And we have write-offs. Write-off is basically the loan went bad. I tried to recover something from it, but I couldn't recover everything from it. So I have to write that loan off from my book. So there was 26 billion rupees in write-offs. Again, this is seen as green because, well, write-offs help reduce a bank's capital provisions and would thus reduce the gross non-performing asset because, well, it's just off my books. I'm not counting that gross non-performing asset anymore. Hence, if I take 310, add 73, subtract 45, subtract 26, I'll come up with the gross non-performing assets for March 24. So gross non-performing assets increased by 2 billion rupees. Now, this again goes to the top graph here, where we see slippages for the quarter. The slippages increased from 73 billion rupees to 79 billion rupees. That means more loans are going bad. If I look at recoveries, lesser money is recovered. Only 35 billion rupees was recovered, and write-offs was right the same. Thus, bringing the total gross non-performing asset in June 2024 to 330 billion rupees, increasing almost 20 billion rupees in a matter of 6 months. Yes. Going on to the last slide. So we discussed little worsening of what is happening in the market. We are seeing HDFC Bank having more slippages, having lesser recoveries, its gross non-performing assets going like increasing from 1.2% to 1.3%. And it also has, as I put it, it has a high like credit to deposit ratio. And if I put all these three things together, the bank has to make up for it somewhere to show some optimism. And that brings us to the slide. This slide basically tells us the capital and liquidity metrics that is basically shows the financial health of a bank. So if I look at capital adequacy ratio, it is critical to ensure that banks have enough financial cushions to absorb a reasonable amount of loss before they become insolvent. That means there is a really good cushion for the HDFC Bank to keep absorbing losses. At NPAs, I mean gross NPAs, though they have increased, but look at PSU banks, look at their gross NPAs, look at their net NPAs, your jaws would drop. HDFC Bank is nowhere near them. Um, so things look good. It has worked on increasing its capital adequacy. If I look at liquidity coverage ratio, so liquidity coverage ratio is basically proportion of highly liquid assets held by HDFC to ensure that they maintain an ongoing ability to meet their short-term obligations. That means if there, for example, if the liquidity coverage ratio is 123%, that means if I have short-term obligations of 1 lakh rupees, I have kept 1,23,000 rupees aside to meet those obligations. So from a long-term perspective, that is capital adequacy, HDFC Bank looks rock solid. Its CAR has been increasing. If I look at liquidity coverage ratio for meeting short-term obligation, since December, it has been increasing its LCR. And that again is a good story. HDFC Bank is a bank that it's a stock that you should look forward to see how market reacts to these results on Monday. I expect a positive reaction by the market, and we can see a Nifty Bank go up. Well, that's it from my end. I hope you guys have a very nice day. Thank you so much. Cheers.